All right, welcome back. It's the Avid Investor Podcast, episode 41, with me, your host, Josh Adamek. And today we're going to talk about market conditions, market trends, market cycles, and things like that. And I know that I just covered this in a previous episode not too long ago, but I've had some people that are very important to me, very close to me, reach out over the last week and a half, 2 weeks, and ask me what the heck's going on here. Is there a correction coming? Is there a dip coming? Is there a crash coming? What's your take? What's your opinion? So I felt the need to revisit the topic here and give you my thoughts and opinions on where we're at and where we'll be moving forward. So, but before we get into that, I wanted to bring up the fact that last episode 40, the topic was consistency is key. And, that now's the time right now. I'm holding myself accountable for that. So it's a accountability check on my end. So when I said, when I say consistency is key, regardless of what you're doing, it's very important to be consistent. Me personally, I fell off. So, and what I'm referring to is I fell off with the podcast here and the recordings. And, for that, I want to apologize. And, again, I'm holding myself accountable. So just a little backstory on that. Over the last several weeks, several months have been super busy with business, family, moving my personal home, finishing up that renovation, and just a lot of moving pieces, kids, summer activities, and all that stuff. And while I'm not trying to make excuses here, I would like to just make mention of why I haven't been here recording the podcast. So over the last month or 2 months or whatever it's been, I'd like to think I've been consistent. I feel that I've been consistent with my business, running my business, growing my business, properly managing, our portfolios that we hold. I feel that I've been consistent, with myself and my family, trying to get the family time in and the activities and be a part of all that and not miss anything. It's very difficult, but I try to be there as much and as often as I can. But where I did fall off was with not being consistent with the podcast here. So, that's where I'm at. Moving forward, I'm back on track now. Things are starting to settle down a little bit, level out, and my plan is to be more consistent here with the podcast and the recording. So I invite you to follow along, to listen along, and again, give me some feedback, give me your thoughts and your opinions on what we cover here, and let's continue to move forward and grow this together. So, back to the original topic, market conditions, market cycles, where we at, what's going on here. And I know you're seeing a lot of this all over the place. Everybody has a different take. Everybody has a different opinion, and everyone is entitled to their own opinion. So what I'm going to give you here today is my thoughts and my opinions on the current market cycle, the current market conditions, followed by market cycles, and what got us to where we're at today, and what I foresee the market being moving forward. And now keep in mind, I don't have a crystal ball. I don't, I can't predict the future. But what I can provide to you is my information and my knowledge about the previous market cycles, what got us here to where we're at today, compared to previous times, and in addition to that, a lot of the information that I'm going to give you, or the thoughts and the opinions that I'm going to give you today, come from people that are very close to me, friends and mentors of mine, that have been in the business for multiple decades, in the business, active in the business, that have been through many market cycles and different conditions in the market. So that's what I'm going to provide you today. So if we just dive into that a little bit, it's been it's been a little bit of an uproar over the last, depending on where you look, over the last week, 2 weeks, things like that about interest rates are going up. Interest rates are going up. I think there was yesterday or today or whatever it is, the Feds raised the rates, and there's there's some things coming out that are saying rates are going up 3/4 of a point, 3/4%. Will that affect the market? Yes, it'll affect certain parts of the market. Absolutely. Will that cause a crash? Will that cause a correction? Will that cause a dip in the market? My opinion, no. It's not going to cause a crash. It's not going to cause the market to go down. What we will see, or what we have seen, over the last couple of months is, if we go back to into COVID times and coming out of COVID, the market just went insane. The real estate market, and as we know, the market corrects. The market corrects every 12 to 14 to 16 years historically, and we're at that point. The last correction we had was 2008, and as I've mentioned many times in the past, going into COVID and the COVID shutdown, we had no idea what it was, what was happening. Many of us have never seen a time where real estate and construction and businesses in the entire world, pretty much the entire country, has just been shut down for 30 days, 60 days, whatever it was. We had no idea what that was, how long it was going to last, what the result of that was going to be. And, myself and many others were like, here comes the correction, here comes the crash, leading into COVID, because we were due for one. So, and then, to my surprise and the surprise of many others, when we came out of the COVID shutdown, the market just went insane. Prices went through the roof, on residential real estate in general. Prices went up big time. There was the whole supply and demand issues. There's more buyers than there were homes available. We were seeing homes that were being sold sight unseen, buyers, retail buyers waiving inspections, cash offers, things like that. Prices going 30, 50, 100,000 over list price, over ask price. I saw in many instances where a home would be listed on the market and there would be 3, 4, 5 offers with no showings. So these buyers, they were so hell bent on getting a home, not losing out, that they were making offers sight unseen, just based off the MLS photos and virtual tours and things like that, waiving inspections. So it was just absolutely insane, just crazy times that we were in, and just crazy things that we were seeing. So, we got that. We had that period of time. I don't recall exactly what it was. It was maybe, it lasted for, maybe 6 months, give or take. Then, we get to that 6 to 12 month mark, following COVID. And it started things started to level out, to flatten out a little bit. It didn't correct, it didn't go down. It just, the whole craziness just started to slow down a little bit. And, that's kind of the period that we're in now, leading up to this interest rate hike. So, there's still supply demand issues in the market. If you read reports, if you read reports provided by the Builders Association and things like that, there's projections that there's something like an 8 to 10 year inventory needed for the market. So for an 8 to 10 year supply needed to keep up with the current market. There's still there's still buyers, there's still folks that want to own homes. We are in a time that's a little challenging right now on the construction side, with the cost of materials, the workforce, just a lot of challenges that builders are facing and developers are facing right now, trying to keep tabs on material costs versus what the market will bear as far as resale price points or sellability price points. So there's a little bit of a challenge there, but there is that demand for homes, whether that's new homes or existing homes. There's still a big demand, a big supply issue, in my opinion, from what I'm seeing and what I've been reading and studying up on. So, and with that, let's talk about the interest rate thing. So we still, in my opinion, from what I know and what I understand about the market, is there's still a need, there's still a demand for homes. Now we have the Fed's raising rates, and as a result, interest rates are going up on mortgages. There's I think we've seen an increase of around 1%. Maybe a little bit more, maybe a little bit less over the last 30, 60 days. And there's talks that that's going to continue to go up. So, what does that mean? Interest rates go up, your mortgage payment, assuming you're financing the purchase of your home, it costs more. So in reality, if rates go up 1% and you're buying a $500,000 house, you got to pay an extra $5,000 per year, on your mortgage. That's a little over $400 a month. So I mean, that's that makes an impact. What that does is when rates go up, it reduces the amount of home that a potential buyer could afford. So the buyers are qualified on debt to income ratios, things like that. So when rates go up and projected mortgage payment is going to cost more, based on a buyer's debt to income ratio, their buying power is reduced. So where we're at in the market right now is prices are up, interest rates are up, and buyers, potential homeowners' buying power is reduced. So there's a spread, there's a margin there that's not really in anyone's favor. So with the cost of construction going up, cost of materials going up, labor going up, just inflation in general going up, things are on the rise, and then buyers having the reduced a lesser buying power, that makes the buyer pool smaller for certain homes. So I mean, that's just the reality. That's the world that we live in. So when you look at that, that scenario, an example, my opinion is that's not going to cause a crash. That's not going to cause a correction. That's not going to cause the quote unquote bottom to fall out of the market. But what that is going to cause is that's going to cause the market to stabilize. I don't think we're at a point where the market is going to go down, because there's only so much margin and numbers that can be reduced, in the transaction to to accommodate buyers' buying power. So what that means is, previously, when interest rates were low and a buyer could afford, a $500,000 a mortgage payment on a $500,000 home, the market that we're in now, their buying power is reduced. So now, I can't do the math off the top of my head, but their buying power may go from 500 to 400, 450, 350, somewhere in that range. So they can't afford to buy the bigger, nicer homes. Their buying power is reduced. But that's, that goes with the market. So, there's potential buyers that were in that, 750 to 800 price point, that $1 million price point, same thing, it's a calculation where their buying power is reduced. So rather than buying the $1 million home, they're buying the $750,000, $800,000 home, depending on where, interest rates are and things like that. So it just, it it affects the market absolutely when interest rates go up. It affects the retail market, and it affects the investor side of the market as well. But we're just talking about the retail side of the market right now. So that's where we're at. That's my take. That's my opinion on the interest rates and how it affects the market. So the real question that I've had over the last couple of weeks, the last several weeks is there a crash coming? Is there a correction coming? Is the bottom going to fall out? And again, my opinion, my take on that is no. I don't see a crash coming. I don't see the quote unquote bottom falling out of the market based on what I know today. A rise in interest rates, 1-2%, is not going to cause the bottom to fall out, is not going to cause a crash. Why do I say that? Because I just explained it. It reduces a buyer's buying power. There's still supply demand issues. Buyers still want to buy homes. Folks still want to own homes. It's not going to cause a correction. It's not going to cause a crash. It's not going to cause the bottom to fall out. In my opinion, it will cause, a stabilization in the market where, the craziness has started to die off. The craziness has started to slow down. It's going to reduce a buyer's buying power, reducing, the buyer pool for the homes that are available. But again, it's a scale. So, the buyers that were buying, the potential homeowners that were buying the $1 million homes are now in the 750, 800 price point, or whatever the math equates to. But you get my point. You get the drift. So I foresee that, in the market where, on the retail side of the market, we're going to see, we may see longer days on market with newly listed homes. We may see a longer absorption rate with new construction, with new developments. The absolute buying frenzy that we saw several months ago coming out of COVID. I believe that's gone for now. I don't see that coming back. But in order for a crash to come, a correction to come, or a dip to come in the market, a crash, something significant is going to need to happen in order for that to take place. So, if we compare, let's just talk about market history, market cycles. If we compare, where we're at in the market today, what we've had coming up to where we're at versus in comparison to the crash that we saw in 2008, totally different. Market conditions leading up to where we're at today and leading up to the crash in 2008. And what I mean by that is if you look at the retail side of the market right now, we're in a crazy, inflationary period where, cost is going up on everything. Values are going up on everything. So what that means is, folks that own homes, that have owned their home for, several years, likely have significant equity in their home. If you bought a home 5 years ago, 10 years ago, and it's been, maintained, chances are pretty good it's worth a whole lot more than you paid for it. So homeowners have, real equity in their homes. So if there's an instance, that something happens and they have real equity in their home, they have options with that home. A homeowner that has, 50, 80, 100,000 in equity in their home isn't going to, grab their suitcase and just walk away from that. They have options, so they could sell the home, potentially refinance the home. There's things that they can do to where they would not lose their home to foreclosure. So there are some things outside of the actual equity in the home that may be factors. If there was a job loss or something like that, or income was affected, of course that would affect your ability to refinance your home. But if you're in a bad spot financially and you have significant equity in your home, you're not going to walk away from that home. You would likely, and keep in mind, we're in a market, we're still kind of in a seller's market here, in my opinion. If you're in a bad spot financially, you have 50, 80, 100,000 equity in your home, you can't refinance, you would sell before you would let it go to foreclosure, right? I mean, most people would use common sense there. So, that's my opinion on that part of the market, on, current homeowners potentially losing their homes to foreclosure. Will it happen? Yes, it will happen, but we're not going to see it by the hundreds or the thousands, that like we did in 2008. Now, if we look at the investor side of the market, over the past 3 years, 5 years leading up to where we're at today, if you wanted to buy an investment property, assuming you were using bank financing, it required a minimum of 20 to 30% down, which means you had to put real money into that home. If you're buying a $200,000 investment property, you got to put 20% down. That's 40 grand plus closing costs. I mean, you're going to be $45,000, $50,000, give or take, cash into that deal. And depending on where it's at, every part of the market is different. But if you bought the property right, put real money into the deal. If it was a long-term hold, you were probably, renting the property, leasing the property, and seeing significant cash flow, because, rents have gone up over the last couple of years. If you bought the property right, didn't overpay for it, you put real money down, your positive cash flow. So the same thing in that example, if there's an adjustable rate mortgage or something that's coming due for renewal, and that rate goes up, 1 or 2%. Does it affect your cash flow? Yes, absolutely. Does it put you into a negative cash flow situation? That depends on how you bought the property. So chances are pretty good if you bought it right, it does not put you into a negative cash flow situation. But in that same example, keep in mind, those investors put real money into that deal up front when they bought it. We were talking $40,000, $50,000. So again, an adjustment in the interest rate on your mortgage and slightly affecting your cash flow on the property isn't going to put an investor into a position where, they're going to let that property go to foreclosure or lose that property to foreclosure. In that example, there are other factors that come into play. And will investment properties go into foreclosure? Yes, absolutely. I mean, it happens all the time, regardless of market conditions. There's other factors that play into that as well. So, that's where we're at leading up into this market. Now, if we go back and take a look, where we were at in 2006, 2007, prior to that, leading up to the crash in 2008, in those times, in those examples, I mean, it was, lenders, financing on properties was just, insane, crazy, 100% loans, 110% loans, the quote unquote liar loans, no doc loans, fog a mirror, you get a loan. I mean, that's the environment that we were in. So that same example back in 2006, 2007, if you would have bought a $200,000 investment property, you may have got that property with, very little cash out of your pocket, maybe $5,000, maybe $10,000, something like that, some closing costs, very little down. And it was over leveraged. It was likely over leveraged, and that happened a lot in all parts of the market, all parts of the country. That is what was happening. So in 2008, when the market crashed, when the market corrected, really, and keep in mind, it was really 5 parts of the country that were hit very hard in that time. The many parts of the country were affected, but there was five cities in particular that were affected and hit hard. But it was, investors were buying based on speculation. Buyers were buying with little to no money down. So builders were building spec homes by the hundreds and by the thousands. Financing was available. So certain parts of the country, like Phoenix, Arizona, and the surrounding area, for example, builders were building entire communities based on speculation. Investors, quote unquote, were investors were buying those spec homes, based on speculation. So they were buying the contract for $250,000 before the home was even built. They would flip that contract to another quote unquote investor for $300,000, and those contracts would trade 2, 3, 5 times before the home was even built and delivered. And then when we come up to the correction, the crash in 2008, Phoenix, Arizona, for example, there were thousands of spec homes that were built and nobody to occupy them. So that's where we saw, the big crash, the big correction is investors were just pouring money with financing that was just 100% financing, 110% financing that was available. They were just buying up all these spec homes, buying all these investment properties with little to no money down. And then when you get to the point and you realize that there's nobody to occupy these homes, that there were so many homes that flooded the market, and there wasn't enough supply, there wasn't enough demand for the supply. We saw the correction, and then in that instance, for example, a quote unquote investor may have bought 5, 6, 8 of those homes for that same $50,000 that leading up to the market that we're in today got you one investment property. So if you look at the investors that bought a spec home in that market, that put 5,000, 10,000 out of pocket, and then there's a correction and there's a supply and demand issue, and rents are dropped just to try to fill these properties. Then you have a 1, 2, or a handful of these homes that you have very little money. You had very little money in. And now your negative cash flow, you can't even rent them for enough to support your debt service, if you could even fill them at all. Now your negative cash flow, $5,000 a month on a couple of homes, or $1,000 a month, $500 to $1,000 to $1,500 per month on one home. That is what caused a lot of the quote unquote investors to walk away, to say, like, I'm done. Let the bank take it back. Let the bank deal with it. I'm not going to continue to hemorrhage, $1,000, $1,500, or $5,000 a month for these quote unquote investments, because I don't see the light at the end of the tunnel. So that's what caused the that's what caused the bulk of the crash in 2008. I mean, that happened in Phoenix, Arizona, and the surrounding areas, down in certain parts of Florida, a few other parts of the country. I mean, that's in my opinion, from what I know and what I understand about previous market cycles, that's what caused the crash. That was a big factor in the crash in 2008, and leading up to where we're at today. We haven't had any of that. We've had investors that have put real money in, 20, 30% down. There's no shortage of investors, institutional investors, companies like like myself and my team at Avid Management Group, that are cash heavy purchases, that just institutional investors that have $50 or $100 million to place, and they're just buying homes all cash. Now they're that example, institutional investors, there is no shortage of them. There's several institutional buyers out there in Pittsburgh and in many other parts of the country that are just buying up homes, by the hundreds and by the thousands of homes every year that are cash heavy purchases. It's no fog and mirror loans. It's no liar loans. No doc loans. I mean, we don't have that. We haven't had that since 2006, 2007, leading up to the crash in 2008. So that is my take. That's my opinion on where we're at today, what we're seeing today in the market conditions and the market cycles, compared to where we were at in 2006, 2007. So to sum it up, like I said previously, I feel that we're in a period of time that the market is going to stabilize. It's going to stabilize. I don't see a crash. I don't see a dip. I don't see a correction, whatever you want to call it. I don't see the bottom, quote unquote, bottom falling out of the market. Assuming there's no other outside factors that are going to come in and cause that. Based on what I know today, I see a stabilization in the market. But with that, if the market stabilizes and inflation continues as it has been over the last several months, over the last 6 months or year, whatever it's been, inflation has been going up. If the market stabilizes, the real estate market stabilizes, and inflation keeps going, that's where you're going to see better margins in real estate and in investments. So that's my take. That's my opinion. Take it for what it's worth. It comes from, those thoughts and those opinions comes from my knowledge and my research of, previous market conditions based compared to where we're at today, coupled with the thoughts and opinions of folks that are very, very important to me, friends and mentors of mine. So I thank you guys so much for tuning in. I thank you for listening, and please give me some feedback on your thoughts and your opinions of, my podcast, my recording. And, again, I'm not asking for anything in return here other than if you find value in the message, please just copy a link, share it on social media, send it to a friend, send it to a family member, associate, somebody that can benefit from the word and the message that I'm putting out there. So thank you so much for tuning in, and have a great day.